Picture this. It's the 1920s and you need a loan. You walk into a bank and instead of pulling a credit score, the lender relies on a handshake and maybe a word from your neighbor about whether you're trustworthy or not. Back then, deals were struck in person, on porches, over coffee, or at the general store. A reputation in the community meant everything. But it all changed after the 1929 market crash. Banks lost millions as borrowers defaulted on loans, and thousands of banks closed their doors for good. Banks quickly realized that handshakes just wouldn't cut it anymore. They needed a structured lending plan and reliable borrowers. That's why detailed credit reports and standardized scores are now a huge part of our lending system. Hi, I'm Keith Demetriades, Certified Financial Planner and Certified Kingdom Advisor. Today, I'm breaking down the biggest myths about your credit score and why protecting it is critical. Because nowadays, trust isn't measured in promises. It's measured in points. More points, more power. Trust has always been the backbone of lending, but these days, trust is in the numbers. Your credit score tells lenders, landlords, and even employers the story of whether you are reliable when it comes to managing money. And when you apply for a loan, that score helps determine not only if you'll get approved, but also how much it will cost you to borrow. A higher score can mean lower interest rates, saving you thousands over time, while a lower score might leave you paying more for the same loan, or even struggling to get approved at all. Did you know that just a 100-point difference in your credit score could cost you tens of thousands more in interest over the life of a mortgage? That's money straight out of your pocket, all because of a number you might not even be checking regularly. It goes beyond loans too. Your credit also plays a role when renting a home, setting up utility accounts, or applying for certain jobs. Good credit also helps access wealth building opportunities, like income producing properties or investing in businesses. It affects every aspect of your financial life. So you might be wondering, how exactly do they come up with this number? It's not random. It's built on specific factors that reflect how you manage your money. You can think of your credit score like a report card for your financial habits. Remember when report cards were written, complete with comments from your teacher? Well, your credit score gives a similar breakdown of how you've been managing your money. Under the FICO scoring model, which is employed by most lenders, there are 5 key factors. 1, payment history. Makes up about 35% of your score. Your payment history is the most important piece of your credit score. Lenders want to see if you pay your bills on time, because if you haven't paid in the past, they're less likely to trust you'll pay in the future. The best predictor of future behavior is past behavior, so pay consistently. The second factor, credit utilization. It's 30% of your score. This is how much of your available credit you're using at any given time. Keeping your usage below 30% of your credit limit is ideal. For example, if you have a $20,000 limit, try to keep your balance under $6,000. High balances make lenders nervous, even if you're paying on time. The third factor is length of credit history. It's 15% of your score. The longer you've had credit, the better. Lenders like to see a long track record of responsible borrowing. If you've got older accounts, keeping them open can help boost this part of your score. The fourth part of your score is your credit mix. It's 10%. Lenders like to see a little variety in your credit. It shows you can handle both short-term and long-term commitments. Credit cards, car loans, maybe even a mortgage. A good mix shows you've got experience managing different kinds of accounts. And the last factor is new credit. It makes up 10% of your score. Every time you apply for a new account, it creates a hard inquiry on your report, which can temporarily lower your score. Something to remember here. When you apply for a lot of credit all at once, lenders might see it as a red flag. It makes them wonder if you're in some kind of financial trouble or leaning too much on borrowed money. Plan your requests with that in mind. All right, we've got the criteria for how you're assigned a credit score, so let's talk about what these numbers actually mean. The scale ranges from 300 to 850, and the higher the number, the better your financial picture looks in the eyes of the lenders. Here's how it breaks down. 300 to 579, this is considered poor credit. If your score falls here, getting approved for a loan is going to be tough. And if you do get approved, you can expect high interest rates. It'll also be harder to rent an apartment or even get jobs dealing with money. It's a tough spot, but it offers great possibilities for improvement. 580 to 669, this is fair credit. You can get credit and loans, but they'll probably come with higher rates. You're not in the sweet spot yet, but you're making progress. 670 to 739, this is good credit. You're looking solid here. Lenders see you as someone who can handle credit responsibly. You'll get approved for most loans and cards, and your interest rates will be much better than someone in the fair or poor ranges. 740 to 799. Now we're talking very good credit. You've done a great job managing things. Lenders love working with you, and you're getting some of the best rates and terms out there. 800 to 850, exceptional credit. You're at the top of the heap. Lenders are excited to offer you their best deals, and you'll be getting prime interest rates on loans. You've put yourself in a great spot. There's also one very important thing to remember here. Your credit score is not fixed. It can go up or down, depending on your actions. It's kind of a good news, bad news situation. You can improve bad credit, but you can also lose good credit. It changes with the things you do or don't do. Your actions have impact. And here's a pro tip. You can and should ask for a better credit card or loan rate if your credit has improved. Many lenders and credit card companies are willing to reevaluate the terms of your account based on your updated credit profile because they view you as a low-risk borrower. More points, more power. So now that you know what lenders look at and what scores you're shooting for, let me give you 7 practical steps to build and maintain your credit score. First, know your numbers first. If you haven't checked your credit report recently, now's the time. The good news is you've got a few options to get it for free. You can visit annualcreditreport.com to access your reports from all 3 major credit bureaus, Experian, Equifax, and the TransUnion. Experian also offers a free report and your FICO score. You can even check with your bank or credit card company. Many of them provide free access to your score or credit report as part of their services. Once you've received your report, don't just give it a casual look. Think of that report like an old ledger book, where every expense and payment is carefully recorded. Checking your credit report is today's version of flipping through those pages. Sit down and go through it line by line. Look for mistakes, things like accounts you don't recognize, balances that aren't correct, or old debts that should have been removed. If you spot something off, don't wait. File a dispute with the bureau. Fixing errors is one of the quickest ways to see an improvement in your score. The second, automate your payments. Keeping track of bills can feel like a juggling act, but missing a payment is one ball you don't want to drop. Your payment history is the most important part of your credit score. One of the simplest ways to stay consistent is to automate your payments. Log into your bank or creditor's website, and you can set up automatic drafts to take care of your bills on time every time. For bills that don't offer automation like rent, a quick calendar reminder can do the trick. Staying consistent shows lenders that you can be counted on month after month. Your payment shows them you're a low-risk investment. Third, shrink the debt and raise your score. If you're carrying multiple credit card balances month to month, you're overextended. Focus on getting them paid down, one balance at a time. You can start one of 2 ways. If you've got one card with a higher interest rate, you might want to tackle that first to save money. Or if you've got one with a small balance, you can go for the quick win and pay it off first. There are benefits to both. Remember though, this does not mean neglecting your other cards. You still need to keep up the payments on your other accounts. The key here is steady progress. Each payment you make reduces the strain on your credit utilization. Lenders see that as a sign you're actively managing your finances. Plus, paying off balances gives you more flexibility when you really need it. More points, more power. 4, look at your oldest accounts. If you've got old credit cards sitting around, you don't have to rush to close them. Keeping your oldest accounts open actually helps your credit score. The length of your credit history is important, and those older accounts show stability over time. They're kind of like old photo albums or family heirlooms. They might sit quietly on a shelf, but they carry a weight in history that matters. But circumstances also matter. If the card is free or low cost, there's no real reason to close it. You can use it occasionally for small purchases, like filling up your gas tank occasionally and paying it off immediately. That way, you're keeping the account active and making sure your credit history works for you. If the card has an annual fee, you'll have to decide whether the credit boost is worth it. If you're not getting enough value from the card to justify the fee, it might be time to let it go. Fifth, apply for new credit wisely. Every time you apply for credit, it creates a hard inquiry on your report. What does that mean? Lenders see you're asking for money. If you do it too frequently, you can start to look desperate, and that's not the message you want to send them. So take a step back before filling out the application. If you need new credit, go for it, but don't apply just to get a discount at a store or collect rewards points on a whim. Also, every time you open a new account, it lowers the average age of your accounts, which is another factor that can hurt your score. So apply only when you really need it, and space out your applications to give your credit history time to grow. 6, show lenders you can handle different types of credit. Lenders like to see that you can manage different types of credit: car loans, credit cards, maybe even a mortgage. It shows you've got experience handling different kinds of financial responsibilities. Now, I'm not saying you need to go out and take on a bunch of new debt just to diversify your credit mix. That's not the goal. A good mix can help your score, but don't go taking on more debt than you need just for the sake of variety. It's more important to show lenders you're managing the ones you have well. 7, keep an eye on your score. Last but not least, be sure to keep an eye on your credit score. Make it a habit to check your score once a month, just like you'd check your bank balance. There's a myth floated around that any check of your credit score can lower it. Not true. Checking your own credit score through services like Credit Karma or through your bank doesn't lower it. These are considered soft inquiries or soft pulls. They don't affect your score. It's those hard inquiries I mentioned before, the ones that happen when you apply for a new credit card, loan, or mortgage, that can impact your score. So you're safe to monitor your own credit regularly without worrying about it dropping. Don't obsess over the little ups and downs. Look for bigger trends. If you notice your score is going down without any obvious reason, take a closer look at your report to figure out what's going on. Maybe you missed a payment, or there's an error you need to fix. It also helps detect fraud. Spotting unfamiliar accounts or sudden unexplained debts could be the first sign of identity theft. Regular monitoring keeps you in control and helps you catch issues before they can cause problems. So here we are, a long way from porches, handshakes, and trust built over coffee. But in some ways, the principles haven't changed. Let's wrap this up with 3 key takeaways. Your credit score is a financial reputation that follows you. Lenders, landlords, and even some employers look at it to decide whether they can trust you with money. A higher score means better loan terms and lower costs over time to you. Next, the biggest factors in your score are payment history and credit utilization. Paying on time and keeping balances low makes the biggest impact. Checking your credit report regularly also helps catch mistakes that could be costing you points. And last, your credit score isn't permanent. It changes based on what you do. Smart decisions are the key to building and maintaining credit. Remember, if you're not improving yours, you're paying the price, literally. Higher interest, fewer opportunities, more stress. So why wait to take action? More points, more power. I'm Keith Demetriades. Thanks for watching, and don't forget to like and subscribe for more financial planning and retirement advice. And if you know someone who could benefit from this information, please share the video. Be a savvy steward. Make your life count.